Hey guys, and welcome to the unicorn model explanation video. We're gonna get started right away. And yeah, the unicorn setup, if you have already spent some time with ICT concept, is basically a 2022 setup. So we look at the same thing. We want to see higher highs and higher lows to be created as a little 2022 model recap. Higher highs and higher lows. Then we want to see the displacement, the pullback, and the continuation into sell-side liquidity, and maybe a specific draw that could be, for example, the previous day's low, previous week's low, or for the bullish scenario, yeah, exactly. We would want to see lower lows and lower highs being formed like this. Ideally, take out a higher time frame point of interest, like same example, previous day's low, previous week's low. So we have these lower lows and the lower highs. We're in bearish market structure. We get the displacement. So we form our first higher high here. We pull back into a fair value gap, breaker block, any PD array, and we continue to make a higher high, higher low, higher high, higher low, and eventually move to the opposite liquidity pool. This could be session, buy side liquidity, like for example the London or Asia session high, or the previous day's high, or previous week's high, previous month high. Any major buy side liquidity pool could be targeted here. Of course, we make sure we take partials along the way, because this would be the best case scenario profit target, but that doesn't always happen. And like we do in the live streams, what we do is we measure this last manipulation move from the latest lower high that we formed. So within this entire downtrend, we look at the last lowest high we formed, and we look at the lowest low, and we measure from the lowest low to the most recent highest high. We use the standard deviation ICT tool. I can show you the settings right here. We don't need these levels. We only need 0, 1, then negative 0.5, negative 1, and therefore you can take a screenshot of that and add that to your tools, and then you have the template saved right here. And then yeah, we would also expect price to, if it's really bullish, like really bullish, to continue all the way up into this area, -4 to -3.5 standard deviations. And right here we would expect the real bullish momentum to come to an end. All right, now we've recapped the 2022 model. So now let's look at the difference between the unicorn setup and the 2022 model. So now we're looking at the ESZ 2023 on Friday, the 10th of November, 5-minute time frame. I like the 5-minute time frame. It's not too quick. It's also not too fast. So that's why we're gonna stick to that. We already look for the 2022 setups on this time frame, so we might as well look for the unicorn setups here. What's important for me to make it a high probability unicorn setup, we look at the New York session example. So if I go into the ICT all-in-one indicator and I turn on the kill zone backgrounds and I turn off the London and Asia session, so we only see the New York session kill zone backgrounds, the AM session and PM session to be specific. We want to see the unicorn setup ideally during the AM session, and especially after the New York Open. So that's another criteria which is making it a higher probability unicorn setup in my opinion. If we get, let me scroll down here, we want to start looking at them from 9:30 until, now let's do 12, lunch hour, and then from 13:30 until 16, power hour included. Let us load up here quickly. So we want to see, for it to be a higher probability unicorn setup, the setup to form right with the 9:30 open or little bits after that. That's really important, because then we can say with very high conviction or probability that the 9:30 or London Open at 3 a.m. opening move to the downside, a one-sided move. That's important. We want to see the one-sided move like we did right here as a fake out move. And when can we tell it's a fake out move? Well, right here, let me zoom in here. I already marked all this off. We formed higher highs and higher lows. Higher high, higher low, higher high. We continued lower, we shifted structure to the downside, so we played the 2022 setup, but we immediately got stopped out. And what's really important here is that look how quickly we have been stopped out. It didn't take very long, or it didn't take many 5-minute candles before, all these slowly moving with lots of wicks down closing candles were completely mitigated basically, and we closed back above our high of the daily candle. Right here, this is the beginning of Friday. Daily candle is moving. Try to imagine that when you're on a lower time frame. Right here, we have the high of the wick on the daily time frame candle. We continued lower, 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 and lower. We almost got to the open. We had our market structure shift for the 2022 model, but it failed. And once we see it fails and we close back above the high, and we're doing this with momentum, ideally within our 9:30 to 12 a.m. timing window. So we don't want to see this being super slow and creeping our way back up, going all the way back into the PM session, continuing higher, and then eventually closing above. Then it's too late for the unicorn setup to show its full potential, in my opinion. So for a higher probability setup, we want to see the initial displacement to the downside from the high of the day. Remember, this used to be the high of the day. Then the New York session came in. We formed a new high of the day. Starting right here with the 9:30 open, we continue lower. We close below our most recent swing low and continue to the upside with momentum quickly. And what we do then is we look for our highest up closing candle between this high and this low. Highest up closing candle would be right here. We use that as our breaker block. And within the displacement lag from this low to this candle's high, we look for inefficiencies. And ideally, we would look for inefficiencies that are already lining up with our breaker block right here. So yesterday, when we were streaming live, I placed my entry right here on this bullish fair value gap. I liked it because it's matching up perfectly with the breaker block. But once we closed above here and continued a little bit higher, we also left behind a new bullish fair value gap. And it really depends on how you want to play these, because most of the time, if we get the unicorn setup, traders have been trapped into a short position because they wanted to see the old low of the day being cleared again. This didn't happen, and now all these shorts are liquidated. They have to buy back their shorts. They sell, they have to buy them back, and that really accelerates this entire movement back to the upside. So we look for an entry around the breaker block, or basically on the breaker block. How you enter on these is completely up to you. You can always enter on that highest fair value gap. You can set your rule to always enter only at the high of the breaker block. You could use a Fibonacci retracement tool and always measure from the low to high of the new displacement to the upside, where we made that lower low. That lower low is important. We made a lower low before, and now we make a higher high. Let me show you what it looks like if we look at market structure right here using the path tool. So what happened yesterday was we continued to the upside, forming higher highs and higher lows. We displace, we give our initial market structure shift, and then we displace immediately again. We retested the breaker block right here, this old highest up closing candle, which used to be the old high for the day. We had the probability for it to remain the high of the day, but once we saw this entire move to the downside immediately displaced, still within our kill zone, we can say with 90% probability that this has been a fake out move to trap traders short. Displaced to the upside, we use a breaker block, any PD array, fair value gap entry, and we continue further to the upside. But this initial market structure shift right here is important. Let me draw this up. Market structure shift bearish, and then we get the market structure shift bullish right here, which I would label as the unicorn market structure shift. And what's also important, which is making, it's not important, but it's making it a higher probability setup. Let's assume that right here we formed the low of our daily candle, and before we did something like this, consolidated maybe here for a little bit. But this is the low of the day, maybe from the London session. London session ended right here. We continued higher and higher, and we cleared the Asia session high with this last move to the upside. And then we get our 2022 model short with this displacement of our most recent higher low. We take that out. We look for our fair value gap entry somewhere around or our bearish breaker block, but it doesn't hold up, and we immediately go to the upside. The confluence that we want to see is we want to measure from our lowest point of the current trading day to our highest point. We want to look at it as a PD array, so the 50%, and which it's really increasing the odds by a lot if we take sell side liquidity below the 50%. So right here we have the 50% level of our entire daily range, and we actually took sell side below the 50%. Let's take a look at what this would look like on a real price example. Right here we have the low of the day. Actually, this would be the low of the day. So we do that. 50% from the high measured to the low of the day. Let me zoom in here and hope these labels are not on the way. This would be a short-term low below the 50%. And what exactly did we do right here? We took out the sell side. And once we took out the sell side below the 50%, the next target would have been down here, because we had a lower high to the left, a higher low to the left, and a higher low to the right. So this is a short-term low. More sell side would have been down here below the 50%. But we take only the bare minimum that we do have to take, which really increases the odds for the unicorn setup. And also another confluence would be if we bounce off the New York midnight level, or being drawn from the ICT all-in-one indicator. So make sure you have that on your chart if you have access to it. And right here, if we would have even gotten a bounce off the midnight level, this would be even more confluence that we could stack to really increase our chances. So for example, you could risk a little bit more if you can check all your boxes basically. We get that immediate displacement to the upside, a new market structure shift above our old high of the day, continue up higher, leave behind the inefficiency paired with the breaker block. We could also enter on the overlapping confluence, so entry opportunities could have been right here on that highest fair value gap. Stop loss really to be really sure, or to not get stopped out by a huge wick or whatever. Place your stop loss one tick below our fake out, our confirmed fake out low. It could retrace further and further and further and still continue to the upside. Usually with the unicorn setups that I have seen so far, this doesn't always happen. So you could also, put your stop loss below the 50% of this entire displacement. Needs to be tested to be safe. Better safe than sorry. Place your stop loss one tick below the slow. Or if you want to spare that tick, place it directly at the slow. Or you could also enter always right here on the breaker block, or like in this scenario, on the overlapping PD array. So we have this bullish fair value gap overlapping with our highest up closing candle with the new displacement. So we could place our entry right here on the breaker block. Let's say we wouldn't have this bullish fair value gap here, and we would only have the breaker block with our bullish fair value gap below. And you always enter on the overlapping confluence. So here we have that bullish fair value gap overlapping with the breaker. Your entry would have been sitting down here, like my entry did from what we did during the live stream. So it's up to your rules and how you perceive what's a good entry. Simply stick to your rules, make them up once, do some backtesting on these, and either always enter on the breaker block, the overlapping confluence, the lowest fair value gap. You could use a Fibonacci retracement tool and say you enter always at the 50% of this new displacement. That's totally up to you, and there are no fixed rules. I think for me, the entry will always be at the breaker block, and especially if it's overlapping with a fair value gap that's starting above the breaker block. Because really, if we have so bullish momentum and we've accumulated, or market makers accumulated longs down here, I don't really expect it to come back all the way into the lowest fair value gap. This wouldn't make sense. So I would simply place my entry at the breaker block and target a 1-to-1 risk to reward minimum. And that depends and already gets us to our last point. So we've talked about what can increase our chances with the unicorn setup, taking sell side below the 50% of the daily range, adding the New York Midnight level as confluence. We want to see a bearish 2022 setup before we get our bullish unicorn setup. We enter off the breaker, or any PD array like a fair value gap, a volume imbalance could also be used. That's really up to you. And now we get down to where we also talked about the timing part. We want to see the fake out move ideally around the opening. And we want to see the displacement happening very quickly. We don't want it to happen within the next session. We want that to happen in the exact same session. And let's say now we talk about how we can use the unicorn setup. So if you already trade the 2022 model right here, like we did on the live stream, and you took the short from this bearish fair value gap, and you took a loss, obviously, the probability is always there that this high remains the high of the day. Even if it's just a 50% probability, it's still worth playing it. But what I would really recommend here is that if you took the loss right here and we get that immediate displacement back to the upside, that you use the same amount of risk, or maybe half the risk, that's up to your risk management, on the unicorn entry, because it has a higher win rate and a higher probability, because this would be our confirmed fake out move. You enter right here, you target a 1-to-1 risk to reward. If you use the same amount of risk that you used for the 2022 setup, where we target a 2-to-1, then you turned a losing day into a break-even day, and not losing money is already winning. Of course, you could also target buy side. We had our previous day's high up here. That would have netted a 1.5 risk to reward ratio. You could have targeted daily buy side, which would have netted at least a 2-to-1 risk to reward ratio, and also would have been hit. You could have even targeted standard deviations like the 1.5 standard deviation. And also, same way as we did it for the 2022 setup, if we, let's get rid of all these labels, maybe it's going to make it a little bit easier and clearer to see. Daily buy side, previous day's high buy side. Let's get rid of these drawings here too. No, not the unicorn market structure shift, only these orange lines. And we can leave the other ones on. What we would do now to measure potential targets for the unicorn setup, since this one has been invalidated, this is our daily range. For the 2022 model, right here, we formed our low, our high. So we would measure from our highest high, like we explained earlier with the market structure example, to our market structure shift level. We use the standard deviation ICT tool, and then we can see, okay, this could be a potential target, low-hanging fruit target, a -1 standard deviation and -2 standard deviation. So now, because this 2022 model has been completely invalidated, we would measure from our lowest point of the fake out move, if we get it close above our high of the day, basically. And yeah, we would do the exact same thing, just inversed. And we would look for targets. -1.5 standard deviation lines up perfectly with the previous day's high. So this could be a nice target. That's what we hit before we consolidated a little bit. -2 standard deviations lined up perfectly with our daily buy side. And -2.5 is exactly where the entire move stopped at the end of the PM session at 4 PM. So you can either use the standard deviations as targets and you simply take partials on the way climbing up the ladder to the -3.5 and -4 standard deviations. You could simply go for a simple risk to reward approach. You could target liquidity, specific liquidity like the previous day's high, daily buy side liquidity up here and partial out. That's really up to you. For the trade day account, I will simply still play the 2022 setup, and if I immediately get stopped out, I will play the unicorn setup to only get back to break even, to make it count as a break even day. It's better than losing, and not losing is already winning. Alright, and the last thing I want to talk about on this example, this is pretty good. What we saw here on Friday, we've already discussed this on the live stream. Right here, let's remove all these things and only look at what happened after the New York Open. So we formed our higher low right here. Let me draw up the market structure. So we formed a higher low, higher high, a higher low, a higher high, a higher low, and then we formed a new higher high. So we're in bullish market structure, we know that for sure. 930, the 930 candle opens up and forms a lower low. So we broke our most recent higher low and we formed a lower low. So this is when we start to look for the 2022 setup short. We have a bearish market structure shift. Unfortunately though, that very next candle already rebalanced the 930 candle, so we did not get a bearish fair value gap entry. We didn't anymore look for shorts, we made another lower low. And what happened after that? We immediately also displaced to the upside. But, major question, did we close above our highest point for the day? No, we did not. We closed below it. So in this scenario, we wouldn't have looked for the highest up closing candle right here between our old high and our new lower low that we have formed. We wouldn't look for this candle as a support breaker block because we didn't close above it. And that's really our fail-safe for the fail-safe unicorn setup basically. We need to see the close above it. We even had the bullish fair value gap. We had reason to believe that can be enough. But yeah, sticking to your rules is really important and which would have essentially saved us from a losing trade here. Because that's what happened. We didn't close above it. We only had a wick above it. And a wick, I always label a wick as a liquidity sweep. And we continued lower to take out these perfect equal lows right here. And we got our 2022 model entry because we formed a low, a high, a higher high, and we broke this low again, forming a lower low. So this is our market structure shift bearish, leaving behind a fair value gap. Compared to this time where we didn't leave behind a fair value gap, we tried to enter short right here. But in case we are wrong and we are immediately displaced, still within our timing window from 9:30 until 12 a.m., immediate displace with momentum. So we see that quick move to the upside. We then look for our highest up closing candle between our highest point right here and our lowest point after the 9:30 open. We look for our breaker block, which would be the highest up closing candle. We look for fair value gaps, any PD arrays, we enter, we target buy side, or we simply target a risk to reward ratio or specific standard deviations. So I hope I put a lot of basically everything I know about the unicorn setup, 2022 setup, confluences, time, liquidity, all into this one video. So you might have to watch it 2 or 3 times to fully understand it. Go back to your own charts and really try to make sense out of it. Because yeah, I think it's the perfect setup that we could use as confluence or as basically a fail-safe method if we are already trading the 2022 setup and it fails. And then we can still anticipate longs at the high of the daily candle or the old high of the daily candle, where we usually only look for shorts. So I hope that really made sense. If you have any questions, feel free to ask me on the Discord server, and I will make sure I get to these questions. I will journal all these unicorn models. I have them right here in my bento book. Let me sign in. Right here in my bento book. If I go over to the accounts, the unicorn model journal, those are all the unicorn models that we had this week. Here we have an example for a London session unicorn setup. We got our bearish market structure shift after taking out the current high of the daily candle, which would have been the Asia session high. We get the displacement. We have our bearish fair value gap, not here on the 15-minute time frame, but on the 5-minute time frame. We had the bearish fair value gap right down here. We entered on that and we've lost. Right here, this would have been the bearish fair value gap where we entered, if you remember. We had the bearish market structure shift. We had sell side to target below. But what did we get? A immediate, quick displacement to the upside. So once again, we look for our highest up closing candle between our low that we formed right after the London Open and the high of the day, which would have been this candle right here. If we take a look at the 15, this becomes easier. So also important to switch between at least the 5 and the 15-minute time frame. We have the displacement to the downside. We look for the highest up closing candle as our breaker block. We see if we get a fair value gap paired with that. We look for buy side liquidity, which would have been here perfectly aligned with these equal highs. So we touch this old high, we retrace, we hold support with the breaker block and the bullish fair value gap here. We also had the VWAP to support price and the New York midnight level. Then we continued higher and also eventually took out the previous day's high, which could have been another, pretty good buy side liquidity target. And if we take a look at the other example that we saw this week, once again during the New York session, we have our entire daily range. We measure that out for the 2022 setup anyway. With the 9:30 opening right here on this candle, what do? We close below our most recent higher low, higher high, higher low, higher high. So we get the market structure shift. We have a bearish fair value gap paired with that. Bearish fair value gap is in. And we enter on that bearish fair value gap. But what actually happened here is we took sell side below the 50%. There's always a probability that we only take the sell side below the 50% and that we do not have the intention to continue lower from here. And we get the confirmation once we close back above our current high of the day, which would have been right here at around 4384. We close above it. We look for the highest up closing candle, which would have been this one right here, as our breaker block, and see how perfectly the breaker block has been respected during, when was that? Tuesday, New York session. We respected it perfectly. We had the only bullish fair value gap we had lining up with our breaker block right here, the highest bullish fair value gap as well on the 5-minute time frame right here. We kept respecting it perfectly, even with the wick. Our stop loss is being placed at the low. And what else do we have? We have previous day's high and previous week's high buy side liquidity above us, a daily volume imbalance as well. So once again, we could either use standard deviations to measure a target and always take profit at the -1 or -2 standard deviation. That's up to your own backtesting. You could simply target a fixed risk to reward. You could target just buy side liquidity. But once again, it's really important. Here, I think we also bounced off the midnight level. It's not on this screenshot right here, but this also adds confidence to our unicorn setups, especially if it happens right with the open. We sweep sell side below the 50%. We immediately displace within the same kill zone. So here we had the fake out move, or Judas swing, as ICT often refers it to or teaches it. At the 9:30 open, below the 50%, sell side liquidity has been taken, bounce off the midnight level, and we get our new displacement, our new unicorn market structure shift. Before 10 a.m., we leave behind a breaker block and a bullish fair value gap. We use this as an entry opportunity to target buy side liquidity or a 2-to-1, 1-to-1 risk to reward ratio above. And I really hope this video helped you. I put a lot of effort into it, so thanks very much for watching, and let's catch these unicorns next week.